There's a strong undercurrent taking the market higher, although the key part here is being selective with which trades to take and put in the portfolio. The man guiding us through is Gary Glover from Novus Capital. Good morning, Gary. How are you?
Yeah, I'm great, Chris. Yeah,
So,
that's definitely the case. I don't know. It's lots of movement in this market. Some shocks, some stocks flying. So there's a little bit of everything in there, really. So yeah, stock selection is critical.
there's definitely been some surprises, some news announcements. Recently, you covered a few things on the takeovers and the non-bindings and the like. There have been reports coming through, and this week, finally, gold's in there, but we'll get to that in a second. On the portfolio, you've got here that it's up. So you're going back to June 2019 when you started publicly sharing the portfolio and all the trades in it. It's up 58.5 versus the Aussie 200, which is 8.13. You don't use the accumulation index because you're rarely fully invested, but here you are. You're pretty much fully invested. Is this kind of the point where we go through this report and go, well, look, you are fully invested, but you've got to be selective of what's in there, and then sometimes you've got to pull even what does look like a good position out? Is that where you kind of are now?
Yeah, that's right. I think you. Yeah, I think in the past I've probably been guilty of being underinvested a lot of the time. So and pretty conservative. So the last probably 18 months, sort of 2 years, they're sort of starting to get a little bit more high conviction on the sort of stuff that we'd like, get a bit heavier on those, and starting to follow some of these sort of rules that the successful or the most successful traders follow. So sort of the old dog's trying to learn a few new tricks, you might say. So just trying to get better, as we all should be. And but yeah, the model portfolio is having, I guess the big thing for me is that I think we're up 29% for this financial year, which is only maybe less 5 months in. So that's pretty good return. That exceeds all the previous years so far. But I am pretty keen to sort of keep going. So I just got my process here. That's the key, I think. Just have your process, stops and targets in place, and it's a game of probability here, Chris, as we know. So we're going to win some and lose some. So we have to, as I was listening to Trading the Zone recently, sort of, we have to be comfortable in the fact that we're going to have losers. As soon as we get comfortable with the fact that we're going to win some, we're going to lose some, and that we don't know which ones are going to be the winners and losers, if we can get comfortable with that fact, then that is when you're trading in the zone. So hopefully we'll just keep following that mantra there, and try and going to have a few losers, hopefully not lose too much, and have a few winners where we hopefully win a lot, and that's going to be the essence to sort of having a good return at the end of the year. So just got to keep up that mantra and keep forging forward. But definitely interesting market, plenty of volatility around, plenty of opportunities. I do think it is definitely a stock pickers market here. So got to look at what sort of stocks and sectors do well in these type of environments in the past, and then try and look at where we are in each of the cycles, and then try to pick the sort of, maybe there's not necessarily the safest, but use some of the technicals to sort of give us some clues on what's behaving. And then if sectors are unbehaving, so a bit like the NASDAQ here, it's sort of probably the one sector that's probably struggling, probably underperforming, although we had a nice pop there last week, because obviously the inflation numbers were just a little lower than expected. That gives it a bit more of a boost, but it still is underperforming there. So I have exited half of my long NAS, and I'll probably exit the other half soon on a little bit more strength. I'm hoping that CPI sort of number will get everyone a bit more buoyant there in growth, but still got the feel here of more of an inflationary market rather than a no inflation sort of environment here. So still seeing like the commodities. I get a lot of questions about regarding commodities and stuff there, and resources there, because I just finding it too hard, because we're sort of, the normal cycle is for commodities to find a low a few months later than equities in this sort of bear phase. But the commodity cycle is obviously very buoyant in commodities in a high inflationary environment. So we've definitely got two different cycles sort of playing against each other. And that's possibly one of the reasons why the Aussie market has shown a bit of outperformance, because some of the commodities are in sort of humming. So, but I still expect that to be pretty choppy there. Some, you're going to see some of those commodities up and down here. So definitely, again, got to pick the right sectors there. We've seen sort of the coal stock started to cool off here. No more hate mail, please. But that's just sort of the, there's just these cycles and these sort of things. So but sort of obviously lithium and has been pretty buoyant. So that's sort of still holding pretty tight. Actually, some of the lithium stocks, and then starting to see gold here move recently. So last night there was a few other metals that were up crazy numbers as well. So still got that high inflationary sort of feel there. So yeah, it's an interesting period here, but we're still trading like we're maybe like a high inflationary environment, which is obviously we sort of still are. But there is some hope there that we can normalize here. So you probably got to. I'm just finding some of the commodities a bit hard there, apart from I'm long a few golds here with quite a few clients there, but that's really the only commodity I'm playing here at the moment. So, but yeah, market's interesting here. I think all the Dow Jones and the S&P, they're all sort of firing up here. They're all following the 60-year cycle. Still pretty buoyant. I think here you've probably got the only thing with that. With some of those charts I noticed, Chris, is we have had a pretty decent bounce, and the normal sort of midterm year bounce out of the October low is around about, I think it's around 20-21% for the Dow and for a lot of the other markets as well. So we're probably already, 2/3 or 3/4 of the way there for a lot of those. So you just might find here that, the first half of the move here sort of comes pretty quickly. The second half here might be a bit more of a grind. So it might be a bit more of a, 2 steps forward, 1 step back, sort of up to this high here. But I still think we'll run up into December there. That's, I think looks quite good there.
So just looking on this chart here, and you were talking about trading in the zone, credit where credit's due. You've done that well with June, August, and October, timing those peaks and troughs. As you're saying with December here, you've got here marked on the chart, 20% equals 34,392. Is that a 20% rally from the October lows? Is that where that number comes from? Okay.
That's right. Yeah. So that's sort of, I think it might be around, I think 21 might be the average there, but I just thought I'll just round it to 20 there. That's sort of that's sort of what we're looking for there. That's sort of, we should be as a minimum move for the, out of this October low here. So, but yeah, it's been pretty buoyant here. So the thing is, if we go back and look at some of those midterm years, we can get some pretty strong bounces out of that period here. So the Dow showed that strong bounce. The NASDAQ has been a little bit obviously more reluctant. So, but we have seen some pretty aggressive sort of bounces out of those periods there. So the NASDAQ, I'd probably just watch that upper trend line. That might be a bit of a resistance point there. But yeah, I still think, there's some positivity there with inflation easing a little bit. I see everyone's sort of getting a little bit more buoyant about inflation expectations. I still have a few concerns there as to whether we're going to come out of it or not. So all I know is we just need to see inflation ease a little bit, and we can get a really strong bounce. So historically, we're showing the past there that the 40s and 70s, just inflation easing back for a year, you can still get a super aggressive bounce in the market here. So still hopeful of sort of that there, but maybe a move up into December, maybe a bit of a consolidation or a pullback, maybe back into Feb, and then hopefully sort of onwards and upwards from there. And hopefully by then inflation will have eased quite a bit more. Then great. If it hasn't eased and it's hanging around there, then we might be in for a bit more of a sidewaysy sort of 40s sort of 70s sort of style grind there, where you're probably up and down 15-20%, which is
wild ride.
Yeah, it will be a bit messy and volatile, but look, still tradable. So we'll see how it plays out here.
Well, that's a good point to say it's still tradable and stock pickers market, like you said earlier. We move into this week's report. You've picked a few shares to trade. We do have some gold companies to go into finally, because you've been having that on the watch list for a while. But we start off with Woolworths Group. Looking at the chart that you've put on here, you've highlighted sort of a previous high where it seems to top out sort of in that August period. And then it's come down, slowed down a little bit, but actually undercut that low sort of in the June period. So what's this signaling to you?
Yeah, so we've actually got, look, I wouldn't refer to it as a triple bottom, but But I think it's basically we've sort of got a marginal new low each time, and then we've sort of got that, so this is like a little 3 thrust low, and is often referred to that. You can get these sort of broadening tops there where you get sort of 3 marginal highs, or you can get these sort of broadening bottoms there. We get sort of 3 marginal lows. So it just goes marginally lower each time, and then reverses there. And they're quite bullish setups here. So we can see the volume has picked up as well. So we've sort of got a false break here on the last low. We've got a big volume there, which is sort of accumulation sort of style. We've definitely come back quite a bit here. Basically 42.50 down to 32. So pretty large correction for what is a fairly sort of safe sort of stock there. So usually your consumer staples tend to hold up best in bear markets, and they are a sort of safe place to be in the bear cycle. And again, if we are in this high inflation, we talked about some things people just don't give up, sort of like food and drink, healthcare, things like this. There's certain inflationary products there that just people won't be giving up there. And if things are tight out there, then maybe you're not going to restaurants, you're probably spending more at home. So just think this is a sort of a good segment to be in here. But the price has come back down on margin new low here, just technically pretty bullish. So this looks pretty positive. So I do like this one a lot here. So it looks pretty bullish.
Well, that's a good one, and noting the volume there. If we move to Endeavour, you're talking about not going to the restaurant. We might not go to the pub and get a schooner and a schnitzel. We might get a Domino's pizza and a long neck. I don't know. I don't drink, but this is Endeavour, right? So this is an interesting pattern you picked up here. I haven't seen much of this in the report before. How do you trade this thing?
Yeah, a couple of things there. So it's funny. I was just talking to another client actually earlier about this, and this, if we are in a tougher environment or recessionary environment here, Australians aren't going to drink any less. That's obvious to me. So this is a good business to Endeavour, sort of split out from Woolworths there, and definitely got a bit of growth there. Sort of still, being sort of separated from the big parent, being able to do a bit more. So do like this company there, has a fairly decent correction there. I think I like on there, there is a little diamond bottom here, which is sort of probably a pattern I haven't really spoken about before, but you can sort of see diamond tops and diamond bottoms. It's more of an observation here, so rather than anything else. These can be sort of highs and lows, these sort of patterns there. But the thing we do have there is we do have sort of a pretty deep pullback, and then we've got a first high low, a second high low, and now a third high low as well in there. So we basically price is sort of starting to tighten up. We do have a nice VCP in there, Chris, too, for that move off the top there. Sort of from the one, so we got a first correction there off into the one. We got a second correction into the two, which is smaller again, and then the third correction to the three there, which is tighten up here. So the whole thing's tightening up here, and as soon as we break up above this little high low here, then that's normally sort of how this goes. So I'd like to look at this here. I think it's a good sector for me, good sector that I view. And although it's quite volatile there, we're basically seeing a sequence of high lows. So if we're entering down here with a pretty tight stop under the last low, we don't lose too much. And if we get a decent sized pop here, then from a risk reward point of view, we've got a good trade there. Yeah, exactly. So we want to be taking trades there where if we're wrong, we don't lose much, and if we're right, we win big. So so I like that one. Looks pretty good.
Well, we move finally to the gold shares. You've been having these on your watch list. You've been talking about the commodity cycle. You've been talking about gold and inflation.
Yeah. I've actually got none in the model portfolio against that. I was like, I've got them littered through the client portfolios, and I've got a few myself. But for some reason, I've been stopped out of all of them on that model portfolio, just because obviously my process there is keeping them tighter here. But I think they look fantastic. They absolutely. They've had a big decline here. As we've talked about, basically energy and precious metals and high inflation environments in the past have been pretty buoyant. So it is a sector which can do quite well, just totally underperformed here. So for me personally, I've tried to buy these a couple of times there, got to break even and then come back and stop me out. Had made any money here, but they finally popped here. So starting to make a little bit of money on some of these golds here. But these are, the charts here are showing big accumulation patterns here on the lows here. So basically, we're talking about 4, 6, 8 weeks of accumulation, like big volume down near the low here. And then we've seen this sort of pop there last week. So we're talking about that US dollar starting to weaken off too. That sort of started to roll off. And that's, a lot of people have been saying that's the reason, that's one of the reasons why gold's underperformed. Probably seeing Bitcoin also getting destroyed here as well. So that's maybe that's helping as well. So I don't know. There's lots of reasons as to why gold might be underperforming here. But all I know is we're seeing accumulation sort of style. We saw, we saw in the 30/30 report there on last Friday how many gold stocks were in the weekly and the leadership group there. So basically, starting to get some momentum in those gold stocks there. So really starting to pop here. But sometimes you can get a pop and you can get a nice rally there. And if it's on light volume, then you don't get follow through. The moves that have usually have the biggest follow through come from having big sort of style accumulations on the pattern there. So I just love the fact that we're seeing big accumulation there. We're seeing a sector which we know. Thing about gold is sort of it's almost, you think about the personality of gold and gold stocks there. They're sort of, they can let you down. They can have these sort of meek and mild rallies, but sometimes they can just rip as well. So they can have a rally which is just really, 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 really takes off. So so I think even evolution as well, that looks pretty good as well, Chris. That's had a decent move as well. So nice little sort of wedge into the low there, bit of a breakout there, and a nice impulsive move on pretty good volume there last week. So maybe you sort of consolidate that. But the thing about gold is, sometimes when it moves, it can really just keep going. It can, not like a lot of sort of normal stocks there. So some of these commodities there, we've just seen it with BHP and Rio and Fortescue the last couple of weeks there. They've just bounced and just gone straight up, and it's gone straight back up into the range in a very quick period of time. So even some of the sort of bear market rallies in some of those commodities can be really, really super sharp. So I'd be sort of almost more inclined to sort of maybe run a 10 or 20 day moving average there or something underneath them, and just sort of just roll with them. So just because they can sort of power on. So I'll be looking for hopefully looking for some sort of consolidation. If I get something like that, a little pennant or a little flag there, has a bit of a breather, I'll probably try and get some in the model portfolio. But I'm excited by some of the gold stocks there. Just the fact that we're seeing them all pop up here. We're all seeing big volume there. We're seeing good reasons as to why they could run. And all the things that possibly been holding them back are all sort of starting to break away as well. So some good arguments as to why they might continue to move here. But at the end of the day, still got to still apply your stops and your targets and follow your process, because even the world best laid out plans, sometimes they don't come to fruition. But it does look pretty promising.
Well, it's good to see that for the gold shares finally, and that massive volume that you're talking about, the accumulation at the lows.
Yeah.
If we move to Bega, so look, this is kind of some of the charts that you've been digging up for years. This is what it looks like. It's sort of, there's a fall, there's a rally, and then a fall, and then it's kind of these false breaks you've done really well for many years on, but has it actually edged lower, or has it just come down to retest it?
Yeah, just come back to retest there. So it hasn't actually gone lower there. So I do personally love to see like even just like 0.5% or 1% lower there, but we just come back to retest the low. The only thing I do like here is I did love that low in July. See the volume there, Chris, the volume spike there. Oftentimes when you see that sort of excessive sort of volume there, that's kind of like Cannigs, these sort of more, I guess you might sort of call them mid cap, or probably less, what I call maybe less traded. So sort of stocks with lower liquidity. When you see those big volume spikes, everyone's sort of getting aggressive there. That can sort of stop the market there. And that's exactly what happened there. That sort of that was basically everyone piling out here at the low, and then basically it recovers and then bounces pretty aggressively. And now we've come back to retest the low there. I just love the last 4 weeks. The volume has sort of basically doubled, and so we're just sort of seeing accumulation sort of down the bottom of this range here. So that's the thing that stands out to me, is that volume there. Also sort of thing, again, like a lot of these food items there are sort of, I think they can weather the inflationary cycle all right as well. So I know the costs go up there, but it's easy just to pass those on as well. So, yeah, I do like Bega Cheese here. I do like that sort of food area. Yeah, it just looks pretty interesting here. So, yeah, I think that looks pretty interesting there. So I would prefer to see a false break, but yeah, it's probably just the high volume there is sort of making it a lot more attractive for me. So, yeah.
Okay, so that's a good one to see, just coming and retesting that, and that volume accumulation right down here near these lows.
Yeah,
that's the critical part.
That's right. Yeah, just the last 3 weeks are just sort of showing some good signs there. So, yeah. Whereas the next chart, we do actually have a false break, but the volume profile is probably not as attractive, but still reasonable. So, yeah, we're seeing there we're sort of actually Domain and REA both do the same thing. Both basically traded down, and actually traded down pretty heavily too. They sort of, I think the day of the low and maybe the 2 days before were pretty heavy on the way down. But it didn't follow through. So we literally sort of got a bit of a bounce there. I think REA had an upgrade as well. All sort of reported there some pretty good numbers. So that was the day following the bounce. It wasn't the bounce. It was actually the day after there. But I think Domain's done the same thing here. Sort of gone to a marginal new low, and bounced out of that. Yeah, I quite like this here because it's the sort of sector which can run pretty hot there. Everyone's getting pretty negative property as well, so it's sort of the whole dynamics is sort of starting to get a bit negative there. Whereas inflationary pressures, there are no, might slow prices down, but we're not going to slow sales down there. And I think those inflationary periods in the past there, you can see a hit to the prices initially from a high inflationary environment. But if you think about it, the cost of goods, if the cost to build a house goes up 7% every year, then the replacement value goes up every year. So, but naturally, the asset is going to have to increase in value year on year. So I think through the 70s, when it was like 7.5% inflation, now I think properties averaged around 9.5%. So when there was obviously some leaner years, some negative years. So, but yeah, the thing about high inflationary environments is people who are long assets are the ones who are the winners. So yeah. Yeah, so I just think you probably definitely get better growth when there's not when the inflation is not as high, but you still get just the fact that the cost of everything goes up every year. The replacement value of all those assets just goes higher there. So yeah,
I think what you're saying there is it's not too true. The assets are the place to be with when inflation's going up.
yeah,
But if the replacement cost of the houses go up, we've heard some of the builders, house and land packages, those companies have gone bust because they can't turn a profit. They can't build the properties for a profit with all the increased cost of the materials.
yeah,
And the flow-on effect's been in the markets, in the housing markets, where those who go to buy a new property, if it's going to cost $1 million to buy a new property and wait to get it, or they can actually go buy existing stock that's fallen 10, 15, 20%, so it's 800 grand. That's the problem that the builders have had. But as you're pointing out here, they're still selling the properties, and Domain is still part of that transaction in a way because there's marketing. So, and they can pass on the higher costs, and they're not going to be miss out because the builder didn't build. Is that sort of...
Yeah, sometimes, yeah. I mean, it's actually sort of seen with these REA and Domain in the past there. Sometimes the negative markets, there's actually more activity. Whereas, if it's but like a hot real estate market, then
they don't need to do big campaigns. They just
and they
sell
can
it.
it's like a lot of them go are off market. So just it's a hot market. They have a database of people looking to get involved. It's it gets done pretty quickly. But and almost a bear market on property. Then you're on there longer. So you actually have to advertise for longer. You're on I think they've sort of shown there that if the average if you're only on there for 30 days or if you're on there for 60 days, then you're going to have to pay to be on there for 60 days. You know what I mean? So, so you have more properties actually on the market. And that's the one thing we're seeing this recently is that the number of new properties there coming on the market aren't that many. So you might actually see more in a decline here. So I don't know, just some of the dynamics around this business are sort of are interesting there, but it's I know you sort of see that sort of pullback there. So I think we've seen a lot of the downside priced in here, but these businesses have been somewhat quite resilient in the past there because they're not necessarily relying on the cycle. So probably the market assumes sort of some cycle working there, but yeah. But either way here, we don't want to be too locked in here. But to me, I like that low. So yeah, if I was looking at here, I'd just be putting a stop in just under that low. If I'm wrong here and it goes lower, then we've cop a tiny little loss. If we rally and go higher, then we've got a big gain there. So that's the reason I like regardless of the fundamentals and stuff here, there's a great risk reward trade there. So those sort of trades where you stand to lose not too much and make quite a lot. Those are trades you want to be taking there because you don't have to get them right too often to pay for all the other trades. So
nice. It's a good way to have it. Definitely the way to have it. And some good books you mentioned in there as well. But we should probably wrap on that. We can say we'll put on screen Gary's Twitter handle on the left-hand side. On the right-hand side, we'll have some of the strategies that he's talked about here in a bit more detail, or some snippets of previous interviews where he covers them in more detail. And then also on the right-hand side, Gary talked about the 30-30 list, which we discussed on Friday, having a lot of gold companies in there. So that's that report where he breaks down those charts in more detail. And to that end, we say thank you very much, Gary Glover from Novus Capital.
Thanks, Chris.